Hi, I'm Michael Bender, one of the principals on the Bender Commercial Real Estate team. We are pleased to present our 16th annual Market Outlook. As you listen, I hope this information will be helpful to you with your business decisions in 2013. First, you will hear from me detailing the national capital market situation and then analyzing the economic health of our community. Reggie Kuipers will follow me with a discussion about the exciting world of retail. Then Andy Anderson, one of my partners at Bender Commercial, will report on the office market. Nick Gustafson will follow describing the investment market. Following Nick, Rob Fagnan will walk through the conditions of the land market. Finally, Doug Brockhouse, my other partner, will discuss the conditions of the industrial market. Thanks for listening and have a great 2013. Before we look at the capital markets, I'd like to take a step back and one more time rehash what changed significantly in the political elections of 2012. As you can see from this slide, not much really changed after the election. Same president, same majority leadership in the House and the Senate, still dealing with the fiscal cliff and the looming debt crisis. However, I believe there was one significant change in the election that many people are not thinking about. I believe this change will sweep across the country, state by state. It's going to calm investors' fears about the marketplace. In fact, you might even say they'll be euphoric about this change. What was it? I bet you didn't guess that's what I was really talking about, did you? Well, that's a joke, obviously. I did want to point out the photograph I took the day after the election from my airplane seat flying over the city of Seattle. It looks like they've already taken advantage of this change. Well, let's get on to the capital markets now. This slide we've used for the last 4 years in our market outlook. We updated it this year again with information from the Federal Reserve. And what I want to show you is the outstanding debt currently held by all institutions across the country on commercial and multifamily properties. The banks and thrift control the majority of that debt, 34%, and the agencies and the life insurance companies and the commercial mortgage-backed securities make up the balance of that debt, the majority of it at least, to represent $2.38 trillion total. Since 2009, we've predicted that we will continue to see deleveraging of properties throughout the United States. And as you can see from this chart, we deleveraged slightly this year. The majority of it took place in 2009 and 2010. However, the next slide will show you some significant areas that I believe will continue to see further deleveraging in 2013, 2014, and even into 2015. This slide tells a very interesting story. As I mentioned, through 2015, there's approximately $1 trillion worth of outstanding debt that expires. That means these banks and lenders will have to renew that debt with those commercial property owners or continue to see deleveraging take place. Now let's shift our attention to the local Sioux Falls economy. The 4-county Sioux Falls MSA topped out in job creation at 3,100 new jobs in 2012. With 3,100 new jobs created in 2012, we nearly broke the record back in 2005 and 2006. What I want to show you, however, is the percentage increase. We ended the year in 2012 with 2.3% job creation for the Sioux Falls economy, and you can see it far outpaces the U.S. economy by nearly 0.9 of 1 percentage point. Now let's look at the 9-year average for both the Sioux Falls economy in blue and the U.S. economy represented in the red line. The Sioux Falls economy over that 9 years averaged job creation of 1.53%. That even includes the down years in 08 and 09. The U.S. economy increased jobs by 6.44% over that same year time frame. What's significant is the Sioux Falls economy outpaces the U.S. economy nearly 3 times as much in job growth over that period of time. Another way of looking at job growth is to look at the unemployment rates. As you can see from this slide, we ended the year in 2012 slightly above 4% unemployment in Sioux Falls, while the national economy was just barely below 8%. What I really want to do is draw your attention back to 04, 05, and 06, prior to the recession. You can see that the Sioux Falls economy closely mirrored the national economy in those years. After the recession, we came out much stronger, much healthier. Look for this pattern to continue in 2013 and 2014. Now let's draw our attention to the total building permits in Sioux Falls. You can see we topped out at $490 million for the year 2012. Not quite as high as 2007, but a record year nonetheless. The yellow line represents a running 8-year average, and we finished well above that 8-year average. No question that was a record year for building permits, but there may be a few cynics out there that think the only reason why we had a record year was because of the construction of the event center. So we decided to look at total building permits without the $66 million event center. As we like to do, we like to compare ourselves to others. And so what we did here is show you some regional comparisons of Sioux Falls and their total building permits. We also decided to show you populations of these MSAs. The interesting thing to note here is Rapid City, with a much smaller population, had a record year as well, but consistently Sioux Falls ranks as one of the top communities for total building permits. Another interesting outlier in the list this year was Willitson, North Dakota. With only about 1/10 of the population of Sioux Falls MSA, they nearly equaled us in total building permits. Clearly a sign of activity due to the oil patch up in North Dakota. Now let's just focus on the commercial construction in Sioux Falls for 2012. If you didn't look at any other slide in my presentation, you should be able to tell by this slide alone whether we're in an expanding market or a contracting market. As we've pointed out before, in a contracting market, the addition remodel outpaces the new construction. You can see in 2012 how that gap has widened with the new construction outpacing the addition remodel. Don't be surprised to see in 2013 and beyond the new construction continue to outpace the addition remodel category. Now let's look even further into the new construction, approximately $165 million last year. There's 4 categories that the City of Sioux Falls provides for this information. Historically, the blue line, which is the office category, outpaces the other 3 categories combined. That's generally due to medical and financial services construction. However, this past year, the yellow line, which is the other category, has seen a significant increase. That's primarily due to the new event center construction. What I want you to focus on, though, is really what's going to happen next year and the years beyond. Don't be surprised to see the green line, which is retail, begin to show signs of recovery with several new announcements of major retail tenants in Sioux Falls. Some examples of new construction this past year include the aforementioned Event Center at $66 million, the Sanford Pentagon and Sports Complex, which represented the other part of the yellow line we just saw, Harrisburg Elementary School, another medical clinic at Vance Thompson. Some addition remodels that were notable, most notable was the Zoo Snow Monkey exhibit. That's an awful nice place for a bunch of monkeys to live, I guess. And the one that most of us have all seen has been the airport remodel. Wrapping up my presentation with conclusions and predictions. The capital markets will continue to see deleveraging in 2013 and beyond, although slower than we've mentioned before. Certainly there'll be new capital transactions as well, but at a modest pace. Don't be surprised to see more capital activity in places like Omaha, Des Moines, and possibly even Sioux Falls, as the major urban markets have been picked over by the large capital groups. Predictions for the Sioux Falls economic outlook include steady job growth. While not quite at the records of 2012, still a very solid year for 2013. This is primarily due to the ag economy possibly lagging behind after a year of drought in 2012. Building permits will continue to be strong in 2013, led by residential, primarily due to continued multifamily construction. Commercial building permits will be up slightly, led primarily by medical and manufacturing.
Thank you for listening to our presentation today. My name is Reggie Kuipers, and I will be presenting on the retail market. Retail is the sexy part of our business. We as brokers, we constantly get asked, what's the next big thing? Who's coming to town and where are they going? The retail transactions get the big headlines, and they're the names that everybody recognizes. When we started breaking down the nearly 12 million square feet of retail space in our city, we saw some interesting trends. Today we're going to focus on those trends, and we're going to focus on 4 major retail corridors. Those 4 major retail focal points are at 41st and Louise, 57th and Louise, 57th and Western, and out on the east side of the DAWLEY Farm Village. You'll notice on this list that only one of these is on 41st Street. The retail corridor has been shifting, and it's been shifting to a smaller niche neighborhood retail such as those seen at 57th and Louise and 57th and Western. We're going to start at 41st and Louise. For the purposes of our discussion today, we're going to look at all the tenant-occupied space. We're not considering the mall, owner-occupied, or the big boxes like Walmart. In the 41st and Louise corridor, we have about 200,000 square feet of retail tenant space. At year end, we had 1 vacancy, 1.4%, and that was a second generational tucked behind retail mall. Average asking rental rates when space is available is anywhere from $12 a square foot for that second generational space all the way up to $20 for the new retail centers. You'll notice that the development is dense in this corridor. In order for new development to occur, a developer is going to have to come in, overpay for his site, raise it, and then build. And I do predict that will happen, and we will see 2 to 3 of these buildings being raised in the next 12 months. The second retail corridor we're going to focus on is at 57th and Louise. And this corridor features those neighborhood retail centers that we were talking about. We've got 150,000 square feet of tenant space here. At year end, we had 0 vacancy. When space does come available here, it's anywhere from $16 a square foot to $18 a square foot. And we will see Noodles & Company opening up in the former Cece's Pizza place in the next couple months. The third corridor we're going to focus on today is at 57th and Western. We have about 100,000 square feet of tenant-occupied space in this corridor. Year end, 0 vacancy. When space does come available, it's anywhere from $15 to $17 a square foot. There has been some turnover, especially in the Bridges project here, but the tenant demand has been so strong, they've been able to backfill it almost immediately with a mixture of local and national tenants. This is the poster child of the new emerging retail center. The city of Sioux Falls recently adopted their Shape Sioux Falls program and updated their zoning ordinances to allow future developments just like this one. And I predict you're going to see new developments like the Bridges project on the corners of 85th and Minnesota and possibly 69th and Cliff in the future. The fourth and final retail corridor we're focusing on today is at the DAWLEY Farm Village on the east side of Sioux Falls. Again, remember, we've thrown out Walmart, Target, and Menards here. We are focusing on solely the 100,000 square feet of tenant space here. At year end, there was some vacancy. In contrast to the previous 3 slides, we had about 11% vacancy. Most of that, if not all of it, lies on the north side of Arrowhead on those strip malls. Average asking rental rates are anywhere from $14 to $18 a square foot. I do want you guys to notice all the green space in the DAWLEY farm. I would look for a lot of new construction in the next 12 months and major announcements from big-time retailers in the next few years. Some notable retail projects that we're going to see in 2013. We all know that Costco's coming to town. Scheels will be doubling the size of their store. Come and Go will be opening 2 new locations, as will AutoZone, and several others, as you can see. Also, just a quick note, there will be 4 new hotel projects going on in 2013. Conclusions in the retail market. We saw a large backfilling of second-generational space. The strip malls along 41st Street went from 38% vacant to 3% last year. Activity was up, vacancy is down. We continue to be a strong, vibrant regional hub, and we have a very healthy retail market. Predictions. The downtowners, the people who live, work, and play downtown, they need the downtown services. They need specialty shops, boutiques, bars, restaurants, daycares, etc. And I would look for that trend to continue. We discussed the East Side momentum already. There's going to be a lot of new construction, some build-to-suit projects, and maybe even a spec development. Last and final prediction, there will be a 3rd Walmart announced this year, and maybe even a 4th. Where are we at on the real estate cycle? After much discussion internally, we went back and forth. We saw some signs of recovery. We also saw some signs of expansion. Like good brokers, we met in the middle, and I would look for us to move into expansion into 2013.
Hi, I'm Andy Anderson, and I'll be talking about the office market. In previous years, you've heard me talk about how soft the Sioux Falls office market has been and how we've had a 7, 8, even a 9-year supply of office space. Well, fortunately, things are changing, so let's get started. The Sioux Falls office market consists of 13.4 million square feet. Now that's inclusive of owner-occupied as well as non-owner-occupied space. As I move forward, I only talk about the non-owner-occupied space of 6.8 million square feet due to the fact that 100% owner-occupied buildings don't affect our vacancy or our rental rates. We break the office market out into 2 sectors, the CBD or the Central Business District being the first sector that I talk about. And the blue bar, which is the inventory, has increased by 85,000 square feet, currently sitting at 2.3 million square feet total. And our vacant square footage did drop by 12,000 square feet. Most of that was due to Avera absorbing the rest of their downtown location. And we did have positive net absorption downtown of 95,500 square feet. The majority of that was due to the new CNA office building that is now 100% occupied. And with that much positive net absorption, it did drive down our vacancy rate by a full percentage point, currently sitting at 12.9%. One building to keep your eyes on is the former CNA building that is going up for auction next month. It will be really interesting to see what transition takes place on this corner. Now let's move on to the suburban sector, which is everything excluding the downtown area. There is a total of 4.5 million square feet, and that is an increase by 110,000 square feet. The majority of that increase was due to build-to-suit opportunities. And our vacancy did drop by 152,000 square feet. The great news is we are absorbing more square footage than we are adding to this sector. A couple of notable transactions that took place over the past year, a building on 57th and Western, as well as 2 buildings up north, the Sioux Falls Development Foundation building and the Corporate Center building, are all now 100% leased. And with the increase in demand we've seen in the suburban sector, we did have a huge amount of positive net absorption, 261,000 square feet. which resulted in a drop in our vacancy rate. We went from 13.1% down to 9.4%. Now we are going to combine the two sectors, downtown and suburban, and look at things as a whole. This slide represents our historic vacancy rates, and the Sioux Falls vacancy rate is currently at 10.5%. And we are still trailing below the national vacancy rate, which is the red line, and that is currently at 15.9%. This slide represents our Class A, B, and C rental rates in Sioux Falls. Take a look at 07. Landlords basically brought in skid loaders to demo space for tenants and amortized those improvements over the term. In 08 and 09, things balanced out. In 2010 and 2011, tenants started to take space as is, and rates were lower. Now, landlords didn't hit a home run with these leases, but they were able to ride out the storm. And things are starting to improve. In 2013, with additional dollars for build-out, I expect rental rates to continue to increase. We did see an increase in our demand in the Sioux Falls office market in both sectors, so it is no surprise that we had a huge amount of positive absorption, 355,000 square feet. And the red bar, which represents our vacancy, is our supply, and that has dropped. But basically, the fundamentals are working in the right direction. We have a healthier relationship between supply and demand. Now, if we don't add any new space, and at our current rate of absorption, we will burn through our supply of 717,000 square feet within 2 years. And as a result of that 2-year supply, is it time to build again? I do think we need to be cautiously optimistic. With the increase in demand, developers may get the itch to start building again and knocking at lenders' doors. However, I don't expect we will see speculative building taking place for another 12 to 18 months. So where are we on the real estate cycle? The market is getting healthier, we are seeing a recovery in rental rates, and we are finally close to moving out of recovery and into expansion. But we're not quite there yet.
My name is Nick Gustafson, and I will be covering investment and commercial sales market. My objective in this segment of our outlook is to inform potential buyers and sellers so they can make rational and informed decisions in 2013. Let's take a look at how we're going to get there. Our company is involved in many types of investment and commercial sales, hotels, storage units, even ag land. But for the purposes of this presentation, we're going to focus on multifamily, office, and retail as they are the most commonly occurring transactions and frankly set the trend for the whole market. We're going to take a look at how these asset classes performed in 2012, and we're going to take a look at how that differs from years past, and we're going to look forward and make some predictions for 2013. First up is multifamily. We're going to take a little bit of time and take a look at some of the fundamentals that are shaping the multifamily market right now. This slide is new unit construction for multifamily going all the way back to 2004. As you can see, in 2008 we had a banner year in new construction. That did have consequences, as we will see in the next slide. There's been a downward trend from 2008 to 2010 with an upward trend to 2012. Let's next take a look at multifamily vacancy. This chart goes all the way back to 2004. The blue bar is Sioux Falls multifamily vacancy across the entire city. As you can see, it's pretty volatile, with a notable point being in 2010 where we approached a 15% vacancy rate. Currently, we are experiencing record vacancy lows. Contrast this with the red bar, which is the entire United States multifamily market, which is pretty regular and steady. The reason we are so volatile in our market is because we are still a rather small market. Factors like recessions, overbuilding new units, and confidence and jobs all affect our vacancy rate and thus causing a lot of variation. The takeaway here is if we overbuild multifamily units in the Sioux Falls market, we will experience high vacancy once again. Let's take a look at what actually happened in the multifamily sales market last year. This chart goes all the way back to 2004 and tracks multifamily sales in dollars. The numerals also reflect the number of transactions in fourplexes and greater units. The red bar is a 9-year average. So we can see we kind of peaked in 2007. We dipped, there was a downward trend at 2010, and we've really recovered in terms of sales in 11 and 12. 2012 was a pretty solid year with 24 transactions and a little over $30 million in actual sales. What's interesting, as you'll see on the next slide, is most of this was wrapped up in one very large transaction, but overall still a very solid year. Let's take a look at some actual individual sales. And the reason we do this, we want to give you a sense on what's selling and what kind of return investors are demanding when they acquire property. First up, we'll take a look at Donegal Point and Center. This was a 191-unit property that was developed between 2004 and 2008. Also included roughly 20,000 square feet of commercial, office, and personal use space. This sold late in the year at a 7% cap rate. Let's take a look at an older property that sold last year. Madison Manor Apartments, 70 units, built in the mid-70s, sold for $2.3 million. This is roughly $33,000 per unit, sold early in the year at an 8.5% cap rate. Notice the higher rate of return the investor demanded on an older property compared to the buyer for the previous apartment unit. Let's take a look at the West 18th Street units. This was built in the early 60s, 31 units, sold for $1.8 million, which is nearly $60,000 per unit. This sold late in the year for a 7.8% cap rate. What's interesting to note here is these were senior apartments, meaning it was restricted to only seniors, and the investor demanded less of a return due to the fact that there was such an efficient expense ratio. Next, we have the Northwestern Apartments. Now, this was located on Northwestern Avenue, 42 units built in the mid-90s. This sold for roughly $1.4 million or $33,000 a unit. Now, the cap rate, 6.5%, was quite low, and that was really due to the fact that this property truly hasn't transitioned yet from a tax credit program, which expired some years back. Thus, the investor believed that they could improve the net operating income on this property. Next up, we're going to take a look at the office market. Now, Andy Anderson has really already covered the leasing and all the true fundamentals that happened in the office market last year, so we're going to focus strictly on sales. This chart goes all the way back to 2004 and measures sales in terms of total dollar volume. As you can see, after some pretty healthy years in 04, 05, and 07, 2008 all the way to 2012, we've had low dollar volumes. 2012 was really not a banner year for us. We performed under our 9-year average, and there was very few true investment properties that traded hands last year. Let's take a look at some specific examples. First up, we're going to take a look at the Evergreen office condos, and this is actually a pretty interesting sale. There's 6 buildings here in the 32,000 square feet, and the office condo concept really never took off in the Sioux Falls market. This was built back in 2005, and many of these buildings were partially completed. This sold to a local investor for $1 million, which equates to roughly $31 a square foot. Keep that $31 per square foot number in mind as we take a look at some of these other properties. Next, let's take a look at the Bitterroot office building sale. 7,800 square foot office building, built in 2007, sold for $104 per square foot. Owner occupied with a little bit of space for rent. Next, we saw the land title building change hands. Sanford purchased this, and it sold for $120 a square foot. This was built in the late 50s with a great location on 22nd in Minnesota. There were 2 buildings here with a parking lot to the north. And lastly, let's take a look at the Social Security building. This was one of the few true investment office sales that occurred last year. This building was built specifically for the Social Security Administration office. 10-year government lease, sold for $266 per square foot. 8.25% cap rate blended for improvements. Now let's take a look at retail. Reggie Kuipers did a great job of breaking down retail fundamentals, so let's go straight to retail sales. This chart goes all the way back again to 2004, and as you can see, retail sales in the Sioux Falls market, man, they've been pretty consistent. When I take a look at what happened in 2012, we were down a little bit from the previous year. There's no reason to be alarmed here. Vacancy rates are low, as Reggie shared. We were just really lacking a big sale. Typically, we have a Michael Arts and Crafts building, we have a Hy-Vee building sell. We just didn't have a really large building change hands. There's no reason to be alarmed here. So let's take a look at some individual sales. First up, I want to highlight the Carmike Theaters, which most of you know is located off of 41st and Interstate 29. This is a 4-acre site with a 26,000 square foot theater. Carmike has really struggled since newer theaters have come to town, more modern, more functional. It was built all the way back in the late 80s. This sold for $1.8 million. This site, we believe, will be scraped and redeveloped as a hotel site. Next up, let's take a look at the Crossroads bookstore sale. Now, this building was built in 2004 and has a 17,000 square foot retail building on it. The new buyer will be repositioning this into office, and this sold for roughly $120 a square foot. Lastly, I'd like to direct your attention to the 41st Street strip mall sale. Now, this is located off of 41st and Kiwanis, 8,100 square foot strip mall built in the early 70s. This sold for $104 a square foot. What's interesting here is you rarely see a 41st Street property change hands. Ownership is consolidated into relatively few holding companies, and the longtime owner-occupant sold this to one of his tenants, the Verizon franchisee. Let's make some predictions. In 2013, when I take a look at the multifamily office and retail markets and their underlying fundamentals, I can confidently predict that sales volume will be up in all three categories. In respects to cap rates or rates of return, with multifamily, we can continue to see cap rates range between 7 and 8.5%, 7 being for the newer units and 8.5% being for the older or more mature properties. Office cap rates will remain between 8 and 8.5% range. Retail will also remain in the 7.5 to 8.5% range. So let's put all this information together. Let's take a look at the real estate cycle, which you've seen a few times already, but really in relation to commercial and investment sales. If you're looking to buy or perhaps sell an office building, you know that office is in recovery. You're still not going to get top dollar if you're selling, and you may be able to get a discount if you're buying. In terms of retail, retail's really on the edge of recovery going into expansion. Retail is going to be something that you're not going to be able to get a discount on, and you can probably sell at top dollar today. Multifamily is in expansion mode, maybe trending into hyper supply. It's a great time to sell an apartment building today. It's also a good time to purchase because the underlying fundamentals are so great. The note and the word to buyers is, be careful, don't overpay for your multifamily property.
All right, well, last year I mentioned that the land market has definitely been a challenge over the past couple years, and that we were finally starting to see some light at the end of the tunnel. For 2012, that light was shining much brighter. In my report today, I'm going to be focusing on some interesting observations that took place in the bulk land market this past year, along with why we've seen an increase in improved land activity. But to start out, I want to take a moment to define what I mean by the land market. By definition, the land sales market consists of 5 different property types, and it all starts out as bulk unimproved land, which is generally the farm ground that surrounds the city and is sold on a per acre basis. Now, when you add in all the services such as curb, gutter, sewer, water, etc., it becomes improved ground, which is used for the 4 other basic property types. These are all sold on a per square foot basis. To start out, let's take a look at the bulk land market.
Back in 2010, we saw that whopping 100% increase in the amount of bulk land sales over the previous year. In 2011, this trend continued and the market doubled down, another 100% increase. As far as 2012, we saw a lateral movement in bulk land sales from the previous year, remaining at 4 total transactions. So the years of 100% increases have finally come to an end. Of the 4 transactions that occurred last year, 2 were for residential developments, selling between $33,000 and $43,000 an acre. The third was for a commercial development at $33,000 an acre, and the fourth sale was for $50,000 an acre and will be used for the future expansion of some of USF's facilities. I would like to note, however, an interesting observation that took place this past year: the purchase of a few improved bulk land tracts. The first to note is the Arbor's Edge residential development, which surrounds Willow Run's golf course on the east side of town. This 200-acre development was originally started by a group out of Minneapolis who ended up going kaput during the downturn, and has since been purchased by a Rapid City group for $6 million. Another similar situation occurred on the south end of town in the Prairie Hills residential development. Local developers started the development at the height of the market, and when the recession hit, they ended up giving it back to the bank. Just this past year, another local developer saw an opportunity and purchased a large tract within the development for $5.8 million. The third bulk improved land sale that occurred this past year was Avera's $13.5 million purchase of the 85-acre Siebert Farm, located on the southeast corner of 69th and Louise. I thought it was important to note these 3 sales because they alone made up $25 million worth of sales in 2013. That's a big number for 3 chunks of land. So what's driving the majority of these purchases? Well, let's take a look at one segment of the market that has a major influence on the sale of bulk land, the residential market. In 2011, there were approximately 3,200 build-ready lots available. And for 2012, at the time of this recording, the city of Sioux Falls has not been able to provide this number. Therefore, based upon our own calculations, we've come up with approximately 3,000 available lots by year's end. So what do I mean by build-ready lots? Well, it means that I could go purchase a lot tomorrow and start building on it the very next day. Now, when you compare the approximate 3,000 available lots, the red bar, to the 884 building permits, the blue bar, that were issued last year, we're sitting on about a 3.5-year supply. Now, during the good years, from 04 to 07, we saw about a 3-year supply. So we're finally starting to get back to where we need to be with supply and demand. Now let's shift gears and talk about that per square foot stuff. For 2012, the total number of transactions increased by 25%, from 27 to 36, which equated to about $16 million in sales. Now it's important to note that the majority of these transactions were for owner-occupied uses. So let's break these transactions down into their individual land use. For the past 4 years, the industrial land market, the red bar, has led the pack year in and year out. But in 2012, that tide changed, and we saw a breakout in the retail land market, the green bar. We also saw a little surge in the office market after fumbling along for so many years. To build on this, I'd like to touch on the going price of these various land uses. The largest margin when it comes to pricing is in the office and retail markets. This is primarily due to the need to be located in specific areas throughout the city. These users are more willing to pay a premium to be in a visible and convenient location, whereas the industrial and multifamily land markets require less desirable locations. Let's jump right into my conclusions and predictions. As far as bulk land sales, several of the properties I discussed were either owned or controlled by some of the local banks, and I think we'll continue to see the cleanup of some of these properties in 2013. Additionally, in order for the market to keep up with the demand for residential permits, don't be surprised to see an additional 4 to 6 unimproved bulk land sales in 2013. As for improved land sales, we saw an uptick of transactions this past year. However, with the majority of these sales being owner occupants and the lack of speculative building taking place right now, we'll see right around the same number of transactions, 35 or so, for 2012. And as for pricing, in 2011 the market bottomed. 2012 showed a rebound, and for 2013 we'll continue to see a gradual increase in the bottom end of those price per square foot ranges within each market segment.
Let's change things up a bit. I'm going to start out with my conclusions and then explain how I got there. My first conclusion for 2012. The doubling of the building permits issued in the residential market was not replicated in the industrial market. New construction, sales, and leasing of industrial property was lackluster at best in 2012. That brings me to my second conclusion. To answer the question of what did the contractors and service providers do to service the recovering residential market, they did what they did with what they had. They did not follow the residential market like they did in 2004 through 2007. Third conclusion, our excuse that decisions in the industrial market were being put off because of the pre-election paralysis ended 4 months ago. That said, there seems to be an even greater amount of uncertainty. Decision-making isn't any easier. And finally, we kicked a lot of cans down the road in 2012, but not many crossed the finish line. In my predictions, I will describe how we expect that to change in 2013. So here's how I came to those conclusions. A quick definition of the industrial market. The industrial market is made up of those properties used for manufacturing, warehousing, distribution, transportation, and contractor shops. For 2012, we surveyed 740 properties in the Sioux Falls market, which equated to nearly 15 million square feet of space, and 309 properties in the T market with only 2.3 million square feet of space. When you first look at these numbers, you say to yourself, okay, the T market is substantially smaller, actually about 60% of the Sioux Falls market. But the more surprising thing that popped out is the size of the buildings. The 740 properties in the Sioux Falls market have an average size of 20,000 square feet, compared to just 7,500 square feet in the T market. You saw in Andy's report that the split between owner-occupied and non-owner-occupied in the office market was 50-50. In the Sioux Falls industrial market, it is 70-30. For those of you that have seen my previous reports, that number is down ever so slightly from last year. The T market, on the other hand, is greater than an 80-20 split. The economics for small buildings just make it easier to own and occupy your property in the T market. I said that the I market didn't keep pace with the residential market in 2012. Let's take a look at how it did. At the beginning of the year, there was 605,000 square feet of vacant space, and we are absorbing space at a rate of approximately 1,300 square feet per day. The Sioux Falls Development Foundation reported 2 weeks ago $160 million in new non-residential building permits issued in 2012. Only $6 million of those dollars trickled down into industrial projects. The total square footage of new industrial was up slightly from last year. We added 196,000 square feet of space in 2012. Here's a slide identifying those projects. Storage units were obviously the hot ticket item for 2012. If you take those out, wow! Here's a look at what's left. What's left? JDS Industries built a new 55,000-foot storage building on 57th Street North, and there was a small storage building added behind Shopko on the south end of town. The amount of turnover of existing space was up significantly. Companies like SMC Corp on 60th Street North closed and left town. LOUISE Concrete moved from Sioux Falls to a larger facility at the Crooks Runner exit. Gears & More moved from their 4,800 square foot building into the vacated 9,200 square foot vacated LOUISE property. All in all, there was just over 500,000 square feet of turnover of existing space. It's time to do the math. At the beginning of the year, 605,000 square feet sitting vacant. New construction added 196,000 square feet, and we saw over 500,000 square feet of existing space turnover. So for the year we had 1,350,000 of available space. Our research shows that on December 31st, 2012, approximately 600,000 square feet of the 14.7 million square feet surveyed was vacant, or 4.02%, virtually no change from last year. Net absorption is our report card for the year. When we take the 597,000 square feet vacant at the end of the year away from the total available, that yields a net absorption of 750,000 square feet for 2012. At 751,000 square feet of net absorption, that is a 60% increase over last year. We are definitely trending in the right direction. Where does that put us for 2013 and beyond? Our absorption rate is up to nearly 2,000 square feet per day. Vacancy was unchanged, so our number of days supply is down to less than 1 year. Now that we have identified the net absorption, let's take a look at some of the sales and leases that went into those numbers. A couple of notable sales. The recycling company located under the 10th Street Viaduct purchased the former vacated Team Industries property on Team Drive. That group of buildings sold for $37 per square foot. The 70,000 square foot industrial warehouse facility located behind the Dakota sold on a contract for deed for $31.69 per square foot. And one of the storage warehouses on Tickman near Tiger Corporation sold for $35 per square foot. Once again, in 2012, we saw a crazy range of sale prices, ranging from $13 per square foot to 5 times that at $65 per square foot. The overall average was around $40 per square foot. The average was around $45 per square foot for well-maintained metal-on-metal buildings. The leasing market was sluggish and we didn't see many deals getting done. There were a lot of inquiries, lots of showings, which indicated that demand was growing, but execution kept getting delayed. A couple of indicative leases that transpired in 2012, Twin Cities Fans took over the southern portion of the Dakota Land Auto Glass at a rate of $3.75 per square foot triple net. HydroClean entered our market and leased the Terran building on Terran Drive for $4.50 per square foot triple net. Once again, the rental rate needle barely moved in 2012. For what we could see, the average rate is up ever so slightly to around $4.15 per square foot triple net. So that's my recap for 2012. For 2013, my predictions are as follows. I believe that a lot of companies burned through underutilized or unutilized space that they were sitting on in 2012. 2013, therefore, will require either an expansion or a move which will result in new construction. Companies looking for a shorter entry time into the market will continue to look at surrounding markets, hoping to find vacant space at lower sale or lease prices. Thirdly, landlords are going to get tougher. They will hold out for higher rental rates and longer lease terms. And finally, I believe that the wild card in all of this is what happens with a drought and the availability of water in our market. For 2013, the I market will build on the momentum that was initiated in the other market sectors and will start up the road of recovery to higher rental rates and more new construction.